I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. So this is Christina Suter with Real Estate Breakthrough. Thank you so much for tuning in. Again, I have Mauricio with me, and he is my favorite syndication lawyer. He knows probably literally, and I mean this sincerely, guys, he has forgotten more than I have ever known. And the reason why I know that is because this is not my area of expertise. This is his area of expertise. And although I have participated in several syndications and am a GP myself, Mauricio has come up against so many different questions and models that I know that he has far succeeded any possibility of me having a depth of knowledge in this area. So welcome to the show. Why don't you tell us a little bit about your background so people know who you are, those who don't know you already.
Thanks so much. Really excited about doing this today. I'm going to date myself, but I've been doing this for a long time, 26 years to be exact. I started back in 1999.
Can I quote the gray hair?
Yeah. I think my kids have to do more with the gray hair at the age. I'm fortunate enough to have just two amazing little girls and just a blessed wife.
Yes.
But yeah, so from a career standpoint, I started practicing in 1999, which I was doing securities, but I was doing litigation, right? So I was doing a lot of trial work and depositions and motion, kind of fun kind of stuff, right?
Right.
But also like a little bit, confrontational, which is not me at all. This is why what I do now is way more fun. But anyway, started back in 1999, and I just worked for an amazing law firm, but I just knew, you probably can relate, and I think most of your listeners can relate to this, where I just thought there was more. I just felt like I was stuck in a rat race. I didn't know the term back then, but I just felt like there was more to this. Just I was literally just going to work all the time. You can imagine law firms, you go to work, you just work all day, you work all night, you work weekends, you keep track of every second of your time. It was just no fun. And so I knew there was something more, and I got super lucky where I got to find this book, right? Rich Dad, Poor Dad, which I know you've read, and I know most of your listeners probably have. Yep. Just devoured that book in 10 seconds. And I just said, yeah, this is it. Like, this is what I've been looking for. And that was really fortuitous for me, because as I was I think it's 5 or 6 years into law firm, I read this book, and then I heard a radio drop-in from the man himself, Robert Kiyosaki, saying something to the effect of, hey, this is Robert Kiyosaki, author of Rich Dad, Poor Dad. If you're interested in investing in real estate, check out the real estate guys. They really know what they're talking about. Yeah. And it was a sort of a promotional radio. It's not the radio back in the day. For the guys, Rob and Russ, real estate guys, they do a lot of educational teaching. And that's kind of what, if I'd not read the book, that thing would have meant nothing to me. But that got me to an event that these guys were putting on about real estate. And I just... They just kind of blew me away. Long story short, I went to work in-house for them, became their general counsel, left the law firm, which I already wanted to kind of leave, even though it was an amazing law firm, went to work as their general counsel. And that's really where I cut my teeth on syndications. I was doing a lot of securities work, but again, we were doing litigation, right? And we were representing sort of the JP Morgans, Merrill Lynch's, American Expresses of the world when they got sued for, whatever, stock violations, securities violations. This was different, right? But this is where I really cut my teeth, because the guys back in the day, old school, by the way, Christina, this is like old school, forget webinars. They were like in-person events, suit and tie. What was the thing that predated the PDF, like the PowerPoint? It was like those acetate things, like those plastic things that you put. That's what they were using.
Yes, overhead projector. Yes.
Overhead projector.
Yes.
I would show up with the printed PPM, private placement memorandum, which we can talk about in a second, but like literally printing it out. People were writing me checks. People were signing, like it was old school. So I met those guys, was their general counsel. It's really where I cut my teeth. And then about, what was this? This is 2007. So almost 20 years ago, 18 years ago. So I went on my own, and I started my own firm, Premier Law Group. And we basically focused, at the beginning you do whatever puts food on the table. It eventually became a specialized in real estate syndications. And that's what we did. And Premier Law Group still does, but I grew that over the last 18 years from basically nothing to a multiple seven-figure business, and decided to exit that business last year. So I ended up selling Premier Law Group to my amazing partner, Bethany, who's kind of taken over the reins. But all the attorneys there that I trained and kind of put the processes in place. So they're now running Premier Law Group. I'm kind of out of that. And I'm now doing something that I really, really enjoy, which is I'm sort of teaching, right? I'm coaching real estate syndicators, especially the younger or the beginner folks, because there's so, as you know, Christina, there's so many landmines, so many, issues that people step on. and they don't have counsel because they just started. Like, I don't have a deal under contract. They don't feel like they need one. And I agree with them. They don't necessarily need to hire a full-time attorney, but they're out there, posting on social media or talking to co-GPs or trying to put together joint ventures or sending, prospects underwriting or spreadsheets and all this stuff. And I'm like, who's reviewing this for you? Because there's all these rules and regulations that you need to comply. And of course, they don't have anybody because they haven't hired an attorney. So I call this like the syndicator blind spot, which is the time like from today until you actually hire an attorney. There's this blind spot that syndicators have. So I wanted to fill that gap for them. And so I created this coaching thing. We get together once a week. It's almost like office hours where I just make myself available primarily. So if you have a question about, hey, can I say this? Can I do that? Can I post this? Was my website okay? Is this a joint venture? Like your specific scenario, you have an outlet, you have an avenue where you can just pop on the call. We do a Zoom call 90 minutes every week and they can ask. So that's what I'm doing now. And it is so rewarding. I mean, I've always loved being on stage and talking and teaching. And like you said, Christina, a lot to be learned in this topic. And a lot of people are doing things the wrong way out there.
I love that you're doing the consulting work. Like how many times do people come up to me and ask certain questions, which we'll get into? And I'm like, well, I believe it's this, but not that. But we want to go talk to a lawyer. I was like, but yeah, how much is that lawyer going to cost me? And no, I don't have a lawyer yet. No, I don't know what. It's like, oh, there's this perfect blind spot. You're absolutely correct. That blind spot is 100% there. Like I run into that as so many times, and I even myself, like I'm a GP now, but I'm hoping to be a GP again and again and again. So now I'm a budding syndicator, and there are things that I know I can't do and can do, but like I said, there's still a lot of stuff I don't know yet that I'm still needing to be educated on. I love that. I really do.
And I'm dealing with this on a separate issue, actually, with family members stuff. But it's not easy to go, like, to your point, if you have a question, it's not easy to go hire a lawyer. Even if you wanted to, it's like lawyers want a retainer. They don't want to just talk to you for 20 minutes or half an hour. They want a significant retainer. And so now it's like you've got to at least do 2 or 3 or 4 hours. And it's like, hey, I just have a question. Like all I want to do is know I met this person at an event. You and I just saw each other at an event in Bigger Pockets, right? We saw each other at BP Con. Like, I just met this person in BP Con. Can I talk to them? Can I send them my pitch deck? Can I send them my underwriting? Like, I don't know. This is what this was meant to be. And so, just very rewarding on my end to be able to help so many people.
And I mean, the cost of hiring a syndication lawyer to put your syndication together, which eventually you will need to do, right? It can be, I don't know what today's prices are, but I know that the one that we just paid for was $18,000 to $20,000.
Yeah.
Right. And it's like, I'm ready to do that only after I've taken a certain amount of steps. And there's that empty spot that you're talking about.
Yep. Right? And a lot of times by the time, for example, when I was at Premier, a lot of times by the time you got to the attorney and you said, okay, I've hired the attorney, I'm under contract, I'd like to do XYZ. And the lawyer will say, well, you can't do XYZ because you did something 2 months ago, or you posted this on social media, or you're now advertising, you're not going to be eligible for this particular exemption, which we'll talk about in a second. But so there are things that you do today that can and will affect your ability to pick a particular exemption, which is why one of the things I advocate quite a bit is making that decision, again, with help early in the process, because whether you decide this path to take or that path to take will dictate the rules and regulations that you have to follow. So it's a lot. And I think one of the challenges I see is that people just don't realize it's a lot. Everybody just thinks, oh, it's really easy. It's kind of secondary. It's like an afterthought. I just need a PPM. I just need a document. Can somebody put together this document and I'm good? Right. And the answer is no, you're not good. In fact, I'm working on a, I don't have it done yet, but I'm working on I don't know if it's a collateral ebook or whatever, but literally all of the compliance issues that you have to address that have nothing to do with the PPM. Like whether your deal is a joint venture, we talked about this before again, that has nothing to do with the PPM. It's not going to show up on the PPM. No. Whether you have properly established a pre-existing relationship with your investor, that's not on the PPM. Whether your post on social media, that's not on the PPM. Like there's a bunch of things, a lot of things that are on that list that have nothing to do with, even if somebody gave you a PPM. Bernie Madoff had a PPM. All of the funds that invested in Bernie Madoff's fund had a PPM. How far did that get them?
How far did they go? And I'm assuming people who are existing syndicators, even if they do have a syndication lawyer, that they can still drop in on your, join your mastermind, being able to get a hold of, just because your depth of experience, I feel like is hard to replace, in my point of view. But so the two most common questions I get in this area, and we talked about them beforehand, and when you mentioned them like that, absolutely. At what point is it no longer a joint venture, and at what point is it a syndication? legally? Like you really want to pony, and I get this question so
Yeah.
often. And effectively the question is, how many members can I get in there before I have to pay for a syndication? That's really their question. That's really what they're asking.
That's the wrong question to ask. You could have one, you could have one investor, or you could have multiple, and it doesn't matter. So that was a question that I would get often, and it wasn't even a question. What I would get was a statement, which I don't want to say I laughed, but it was kind of, now that I look back on it, it's kind of amusing. But they would make a statement like, "Hey, Mauricio, it's kind of a small deal. It's only like $1 million. It's not a big raise. It's only friends and family. It's like, I think I'm going to do this one as a joint. I think I'm going to do this one as a joint venture." Oop, I think I lost you.
Oh no, I'm here. I was just making noise, so I'm
sorry.
Here.
My apologies. I've had some issues. Let me just say that again.
Okay.
So it's more of a statement. So they would say, "Mauricio, this is kind of a small deal. It's friends and family. It's like less than $1 million. I think I'm going to do this one as a joint venture." And I would just kind of sit there and smile or laugh because whether something's a joint venture or a syndication, you don't get to make that decision. It is what it is. The regulators will make that decision. So it's not so much whether you call it a joint venture or not. It's how is the deal structured. And the easiest way I can show this is, number one, understand what a security is. Let's give the layman's definition of what a security is. Okay. And that way, in order to do a joint venture, it's almost like the opposite of a security will be your joint venture. So let's go through what a security is, because it's one of the first questions you have to, is you taking somebody's money a security or not? That's kind of a foundational question. Again, a question a lot of people mess up. Okay. And so another reason to be on sort of the inner circle. Anytime you take money from passive investors, where the returns are generated by your efforts, meaning you're doing all the work and the investors are writing you a check and going home, that is your textbook definition of a security. It comes from something called the Howey test. It's like a 4-point thing, but that's what it is. You're taking money from investors, they're expecting a return, and you're the one, or your team are the ones that are generating return. That's a security. You could have one investor in that security. You can have a million, maybe not a million, but a lot, right? That's the focusing question. Right. Really, how it comes down to who's making the decisions. How is the return generated? So in order for it to be a true joint venture, then think of it as the opposite needs to happen. Meaning you're going to get a bunch of people together, not too many, where the returns are going to be generated by everyone's effort. Everyone's ponying up. Everyone's rolling up their sleeves. Everybody's got some kind of specialty that they can bring to the table, and they're being brought in not to raise capital, but to start a business, basically. If you've got 3, 4, or 5 people, everybody's got some talent or some work, and everybody's going to roll up their sleeve and they're going to do the deal. And that way, the returns will not be generated by any one specific effort. Now, that doesn't mean everybody has to do the equal work. It doesn't mean that if I have 4 people, it's 25% each. But generally speaking, you want to keep these things less than, let's say 5 is about what I've read a lot in the SEC, like 5 or less. It's very. I'm not saying you can't do it with 6 or 7, but the 10, 15, at some point, it's very difficult for you to show that all 7 of you are actively involved. Somebody in there is passive, right? But that's what you're looking for. And so generally speaking, you could definitely have somebody, for example, that only owns 10% of the joint venture because they're busy. They have a full-time job. They can only work on this deal on the weekends and at night. So that would make sense. But that person generally would be bringing about 10% of the capital. They would be doing about 10% of the work. And they would have, most importantly, they would have 10% of the voting rights, which they need to be able to exercise. So, for example, if the joint venture doesn't, like say, Christina, you're the manager, or sort of it's okay to have a manager who runs it in. I want to vote you. We as a group want to vote. We don't like the way you're doing it. We'd like to replace you with Mauricio. They have to be a real opportunity to do that. And you can't block it. So it's almost like your voting rights don't matter. So the more control an individual has in a joint venture, the more it starts to look like a securities offering, and the more decentralized the control, that starts to look more like a joint venture. So even if somebody's running the day-to-day, right? Because, if you want to go buy a pencil at, Home Depot, or not Home Depot, Office Max or whatever, you don't want everybody to have to sign on that. But any major decisions, right? Whether to buy, to sell, to hire a property manager, to refinance, to do something, hire people, that's where you want everybody to be voting, even the asset manager, just changing that day-to-day person. And then you want to avoid syndication type terminology. You don't want to have preferred returns. You don't want to have, asset management fees. Like if everybody's contributing, why would you have an asset management fee? Acquisition fee, maybe if somebody found the deal and so then they, maybe brought the deal to them, maybe they can get a little bit. But even the terminology, I wouldn't even think of them as investors. I think of them as partners. They're my joint venture partners. We're all in business together. I'm not really raising capital. I'm just really, I'm aggregating capital, but I'm also aggregating labor and expertise and knowledge and credit and all that other things, because as a team, we're going to be able to go do this deal. But I don't like to look at it as a capital raising tool, because it's more of starting a business. That's what a true joint venture is, which, as you can imagine, very few joint ventures that I see pass that test. Most of them are just unregistered securities offerings where people are calling it a joint venture, but really they're just unregistered securities.
I like the conversation, the focus on what in IRS terms they sometimes call it material participation.
Yes.
Right? So I like that you're basically pointing to material participation.
Very similar, yes. In fact, can I just tell a quick story? I was actually talking to a client and they were trying to figure out how to make a particular investment eligible for an active, for the IRS to be active. And so they were using material participation, as you pointed out. So we had the CPAs, like, as long as we're doing that, and I think that'll work. And then I said, wait a minute. If they are materially participating, then we constructed this as a joint venture, because obviously in order, that's what a joint venture is. And I think there's only 2 or 3 parties. And so, yes, it's very, very similar to the material participation. It's like who's generating the returns. And as long as everybody's materially participating in generating the return, like a real business, that's why the tax benefits exist for active business, because they consider it an active business that you're running. Yeah. So anyway, that's a great analogy.
Okay, cool. So that one is the joint venture conversation. I love your description. Very, very concise, very easy to understand. 2 basic points. Right? Are they involved?
Christina, the reason it's easy to understand is, as you know,
right?
I have been told that I am one of the few lawyers that actually speaks English. So naturally,
that's what it is. That's why I relate to you so much. Is you actually speak English. There, not just legalese. You actually speak.
That's right. Yeah, my buddy Tom Wheelwright likes to say that all the time. So I quote that often. But sorry, I didn't mean to interrupt.
Oh no, it's a great quote. It's a great quote. I do know of Tom. I don't know him personally, but I do know of Tom, and he's very, very engaging to watch as a speaker as well.
He's great. Yes.
Okay, so that's question 1. The second question I get the most often is, so I'm just going to raise capital for this group, and they're just going to make me a GP, and that solves the problem, right?
Yes. No, it does not solve the problem, because in order to raise capital for other people, you need a license, right? Just like in order to practice law, you need a law license. If you want to practice medicine, you need a medical license. If you want to practice the art of raising capital for others, then you need a broker-dealer license, right? Now, very few people. Now, there is an exemption to having that license, which is what all of the syndicators out there rely on. So if you're the main syndicator, you're the lead, or it's just your deal, then you're going to fit into this exemption so that you don't have to become a broker-dealer. But when you're raising money for others, and that's your sole or main purpose, then you're going to fail this exemption. And so you fall back to this original thing, which is you need a license to do that. And of course, most people, or almost every person I know, does not have a broker-dealer license or even a registered representative's license where they could hang their license under a broker-dealer. But the rule states essentially there's really 3 things you have to do in order to be eligible for this exemption and not have to be a broker-dealer. Right? Because forget it. Broker-dealer, forget it. It's cost a ton of money. As the regulations are obscene, like that's not an option for you if you're thinking about this, right? But you have to fit into these 3 things. Number 1, you cannot get paid transaction-based compensation, right? So I can't get paid based on how much I raise, whether I raise. That's not what I'm getting paid for, right? And that's compensation. It's not cash. So you can't pay me with cash, with bananas, with co-GP shares, with free vacation at my resort. Any type of compensation is not allowed in order to make it transaction based. So just because, think about it, if you're giving somebody a co-GP share, which happens all the time, hey, if you can raise $1 million, I'll give you 10% of the GP. If you can raise, $2 million, I'll give you 20% of the GP, or whatever percentage. That percentage of GP, think of it as shares. You're just compensating that person with shares of a company, in this case, membership units. But that's compensation. So you cannot have transaction based. If you have that, you're done. That's the hallmark of broker-dealer activity. So no transaction based compensation. The second thing you have to do is you have to be engaged in what's called substantial duties. Not too far off the material participation kind of thing, but you have to be doing substantial duties. Like and when I say substantial, I mean substantial in the actual deal itself, not in the capital raising phase. So once the property closes, for example, or the offering closes, the property closes. Now what are you doing? What are you doing in the asset management? Are you the asset manager? Are you the property manager? Are you the one that's investor relations, really engaged in the? What are you doing after the deal closes? Because if you just go, you're working on the raise, and then the thing closes and you go home and you're just like, just enjoying the fruits of your labor, that's problematic. But you have to be doing what's called substantial duties. And I get it. It's a little bit nebulous term. It's not super well defined. But number 1, no transaction-based compensation. Number 2, you must be doing substantial duties. So if you're the main GP, that's what you're doing. Or if you're the only syndicator, that's what you're doing. And then the last thing is that your primary role needs to be something other than raising capital. Your primary role cannot be the raising capital. It has to be incidental, right? So as a syndicator, you're doing a million things, right? You're doing the underwriting, you're doing the due diligence, you're talking to the lawyers, you're doing this, you're doing that. Capital raising is part of that, but it's not the main thing. It's incidental, or certainly not the primary thing you're doing. So anybody else that comes from the outside has to be doing substantial duties, and they're most of their time, which to me is just how much time did I spend doing capital raising? How much time did I do doing my substantial duties? I have to spend more time in the substantial duties category than I do raising capital. And most people who come in just to purely raise capital usually fail all three. Number one, they get paid based on how much money they bring in. Number two, that's their primary role, and they're really not doing substantial duties. They're just showing up to a couple of meetings, which again is beautifully related to this material participation thing, because the IRS has stated that just showing up to meetings and kind of administrative work, that does not constitute in terms of hours towards a material participation. And this is the same thing. You can't just show up to meetings and check in and get roll call, and somehow now you're substantially, you're having substantial duties. So that's the reason most people fail, is that they fail one or most of the time all three of those that three-pronged test. Yeah, and that's what it's called the issuer exemption. If somebody wants to look it up, you look under the issuer exemption. I think it's 3A4-1, and those are all your elements. And that's kind of my layman's summary of what you need to comply in order to be able to avoid having to register as a broker-dealer.
No, well said, well said. And it's because there's a lot of space between being a GP, quote unquote, and raising capital as a GP versus being a broker-dealer or being a registered representative. Like the amount of so much
awful.
Space.
Yeah, forget it. Yeah. But I did talk to somebody the other day who was and it was great, because then you can get a commission, and at our level, and when I say at my level, like, even though they may sound like big numbers sometimes, they're in the grand scheme of things. When you raise $10 million or $5 million, that's not a lot from a broker standpoint. So a lot of the brokers that I've seen in our space, that the ones that are raising a few million or 5 million, 10 million, they usually do a hybrid. So they'll take a commission, which they can because they're licensed. So maybe I say, hey, I'll take 3% versus a broker dealer might take 8 or 9. I don't know what the going rates are today, but they would take a smaller percentage, maybe 3, but also will take a cut of the GP depending on how much money they bring in. But they are licensed. That's why they can do that. They are a registered representative under a license, and you can go under FINRA, which is the regulatory body, and you can type in their name, you can type in their number, and you can see, are they in good standing? Do they have any disciplinary actions? It's all public record. So, but again, 99% of the people out there who are raising capital for others in our world, they're just trying to get around it by claiming that they're a legitimate co-GP, but you've got to go through that 3-prong analysis.
Again, very well stated, very well said. So what do you think are what would you say are the primary things that a new syndicator just miss? Beyond I want to do a joint venture, but really it's a syndication, right? There's that one. But what else do you feel like they just miss it?
And I think that JV one is part of the bigger question, which is they don't even realize they're selling securities, right? Whether it's a joint venture is one example, promissory notes are another ones. They just think, I'll do this one as a note, or I'll do this one as a creative structure. And again, the structure itself doesn't matter. So I think that's one of the big landmines people step in. The other one that early syndicators step in is because they don't make that decision, or they don't quite understand the different exemptions, which I think we need to talk to before we go, because that's really important. But understanding the exemptions that they're going to rely on, because then if they don't understand it, then they start posting on social media, or they put stuff on their website, and that literally blows a particular exemption, so they won't be able to use that when they're ready to go. So that's another one. And then just communications. Here's another one. That's another quick story, and then we should get into the exemption real quick. But the other quick story was when they would call me and they would say, Mauricio, I need the documents now. I need to hire a lawyer. I need the documents. I already have all the money raised. I just need the documents. And I was like, OMG, like, what have you told these people in order for them to commit to you, to commit to $100,000 or $50,000 or $200,000? You must have shown them something, a pitch deck, a business plan, an underwriting, a this, a that, the other. And all of those are communications. And the SEC and the state regulators, which by the way are probably the most dangerous ones out there, not the SEC itself, it's the states. They not only regulate the sale of securities, which is when they actually wire the money, but the offers. So all those communications that you're sending out to investors, and like, here's my pitch deck, here's my this, here's my emails, those are all potentially offers, which would be violating securities law. So that was another one that I think, again, people, the communication, you just got to be super careful to make sure that when you're communicating with investors that you're not making offers, that you're not promising anything, you're not very, because the PPM, the private placement memorandum, all the disclosures are so necessary in these situations that you need to do that. But real quick, and I know.
No, let's do the exemptions.
So it's super
that point
important.
was so that I'm glad we did that point, because that point is so important, because I know so many people who have done exactly that. I've got the deal, I've got the investors, I've got it all lined up. Okay, now I have the money to pay for the lawyer to get the PPM. And I was like, oh, wait a minute. You were
backwards.
You know,
It's backwards.
Screw, it's backwards. It's backwards.
Because the general rule is, again, general rule is that when you sell somebody a security, which we've already talked about what a security is, so now you're getting past investors, you either need to register that security with the Securities and Exchange Commission, the SEC, or you need to find an exemption.
Right.
Or it's illegal, as I like to joke. So you have to register, find an exemption, or it's illegal. So we're not going to register because that's going public, IPO. We're not going to do anything illegal because we don't want to be Bernie Madoff. So we're always looking for an exemption, right? And that's the critical piece. And each exemption has different rules and regulations. Now, the most popular ones, anybody listening to this who's interested in raising capital, most likely will rely on one of these two exemptions, even though there's a bunch of others. There's specific reasons why these are 95% of what's out there. And these are the 506B and 506C exemptions. So if you ever hear those terms, 506B, 506C, all that means is that these are the exemptions that we're looking to rely on so that we don't have to register. Because if I don't have an exemption, I just have an unregistered offering, which is problematic. So 506B, 506C are the two exemptions, and they have different rules and different things you can and cannot do. So if somebody asks me, Mauricio, can I advertise my deal? Well, the answer is, well, what exemption are you using? Because if you're going to rely on 506B, that's a no-no. You've just violated 506B and you're not going to be eligible for 506B exemption. So you better find a new exemption, and you probably don't have one. But if you're going to do 506C, then you can absolutely advertise, and you can go on social media and you can scream from the top of the mountain that you have a deal. But you're only going to be allowed to take accredited investors only, right? So understanding what an accredited investor is, it becomes important. So all these things need to be decided early in the process so that you know what rules and regulations you have to follow, and you know what landmines I need to avoid, because there are different landmines depending on what path I start at the beginning of this journey.
That it?
I can keep going. You want me to go through the elements?
Yes. Yeah, go through the elements real quick.
Okay. Yeah. So the elements are actually, the elements of each rule are fairly similar, right? So on the 506B, right, 506B, which is the original, you can raise an unlimited amount of money. So if you want to raise $1 billion, knock yourself out. In fact, I think Blackstone has the largest real estate fund I've seen, which is I think 50 billion, and it's a 506B. So even the big boys, and girls use 506B. So unlimited amount of money. You can take up to 35 non-accredited investors, which is one of the reasons it's so popular. So your family members, your kid, your high school buddies, or somebody in your raise when you're starting probably is not high net worth. So this allows you to take up to 35 non-accredited investors, so long as there's some level of sophistication there. The drawback of 506B is you cannot advertise or generally solicit. You cannot go on social media. You cannot put these things on your website. You can't go on podcasts like this and be like, oh, by the way, I've got a deal. Why don't you call me and or have a webinar tomorrow? Can't advertise. It's meant for people that you already know. It's people who are already in your inner circle, your friends and family, and people that you generally have what's called a pre-existing substantive relationship with, right? So when people say to me, oh, this is just friends and family, I'm like, yeah, that's a 506B. It's not like there's no free, I don't have to worry about it. Perfect. It's friends and family. Great. You have it's a 506B, and you have an obligation to provide an extremely high level of disclosure documents and information to those non-accredited investors. That's what a PPM is. A private placement memorandum is simply a disclosure document. And if you have non-accredited, which you'll have in a 506B most likely, you have to give them all of the disclosure. And failure to give a disclosure or omitting a particular fact, meaning leaving a fact out, could put you into trouble. So you can raise up to 35 non-accredited, but you cannot generally solicit or advertise. You've got to call what's called generally a pre-existing substantive relationship. About 10 years ago, 12 years ago, a new exemption came out after the financial crisis called 506C, right? They added it, right? So it used to be just 506. Yeah. Now they've got 506B, 506. 506C also can raise an unlimited amount of money. But the good news is you can advertise, you can generally solicit, you can go on everything that we talked about before, but your limitation is going to be you're only allowed to take take accredited investors only.
Yeah.
and you must take what's called reasonable steps to verify that they're accredited. I can't just take their word for it like I can in a 506B. And so that generally involves these days it involves just hiring a third-party verification company for you. They're really, really inexpensive. But generally they'll get either a CPA letter from the investor CPA that says certain things that, hey, this person's accredited, or you're looking at tax returns, or you're looking at, W-2s if it's income related, or if it's, if assets based, you're looking at, your appraisals and value and bank accounts or whatever. So there's ways to do it, but the easiest way by far is to either have a lawyer or their CPA do the verification. And that's what the verification companies basically do. They have a lawyer, a low-level attorney that kind of reviews the documents and then writes a letter to you, and that's good enough for you. Yeah, those are by far between 95% plus of the exemptions people use are one of those two. And there's a reason for that. Number one, they preempt the state, so I don't have to worry about the states if I use one of these two exemptions. Like imagine, we have a state level and a federal level, and so if I had to comply with both, and you have investors in 7 different states, now I got to go worry about the law in Florida and Texas and California and Massachusetts and hire lawyers all over the place, and it's a mess, right? So when I do these, I don't have to worry about the state securities laws other than the anti-fraud provisions. You still can't you can't be Bernie Madoff and expect to get away with stuff, but I don't have to worry about whatever I don't even know what the rules are. Like I joke, I'm in California. I probably should know the California securities laws, but I don't practice California securities laws, right? I used to practice federal securities laws. So, so that's one of the reasons. And then there's safe harbor. So if you just hit these points that I went through, you can, stick to, if it's a 506B, just make sure you don't advertise, that you can show that you have an existing relationship with them, and you limit it to 35 non-accredited, and you kind of follow the rules, then it's a safe harbor. So you're assured of compliance, and lawyers and syndicators generally like assurances. They don't want to guess.
No, they don't want to guess. Well, this is amazing, and I so appreciate all the knowledge and being available. And I love that you have this inner circle, I believe is what you call it, your inner circle program. It's fantastic. I think people would be, if you're thinking about being a syndicator, you want to do a joint venture, but you're not sure, if you want to get easy access that's less expensive than a retainer or a PPM is. This is just brilliant. I don't think I know anybody else who's doing this, by the way. I know zero.
I don't think there's anybody. And we go through social media posts, and people are like, oh, can I post this on social media? Well, let's take a look at it, and let's tear it apart, and let's show, hey, what about my website? Can we do a website, like an audit, and just make sure the website's compliant? Because again, 506B, I can't advertise, I can't put anything about the deal. So yeah, we just answer very, very specific questions that as opposed to some more general stuff that you'd probably get if you go on YouTube or something else. It's very specific to your claim. I
love it. So how do people get a hold of you? And I'm going to drop a little teaser here. How do people get a hold of you? And I believe you're working on a book in secret.
I am working. Secret. I haven't talked about. I think the only thing I've put on. I'm on LinkedIn quite a bit. So if you're in social media, right. LinkedIn's a good place to get. I post a lot of free, obviously, just content out there. But I think I teased the book on LinkedIn a couple months ago because Robert Kiyosaki, again, a very, very influential person in my life, has written the foreword for this book, and I'm co-writing this with another really well-known syndicator. And Robert wrote the foreword to the book, so that was exciting. And it's from somebody that I've now gotten to know a little bit, and know all of his advice. It's kind of a cool thing for that to happen. But if you're interested, so LinkedIn. That's a full circle. It is totally full circle. And what really is cool, just a quick story here, is I got and I've shared that. I speak all over the place, and so I see him all the time at these events. But I got at a private party. Actually, it was for the real estate guys. I think it was their 60th birthday party or whatever. I went up there, I said a couple words, and I kind of told the story I told earlier on today, and he was in the audience, right? So he was there, and I was actually sitting right next to him. So as soon as I'm done, I go back to my seat where he's sitting next to me, and he just kind of gave me a pat on because it was like an homage to him, right? It was a big deal. So it's kind of full circle. It's nice to have him write the forward, and I don't know when the book's coming out. It's probably, if it's not by the end of the year, it's probably Q1 of next year. So I know I'll be announcing that on LinkedIn. So follow me on LinkedIn if you'd like. It's just Mauricio Raul. And if you've got any interest at all to join us on these weekly calls, you can go to coachingwithmauricio.com. Nothing fancy. It's just kind of a capture page, and then I'll reach out and we'll see if it's a fit.
All right. Coaching with Mauricio, Mauri. So CIO.
Yeah, Coaching with Mauricio.
CIO, because not everybody knows how to spell your name. It's elegant and it's beautiful, but not everybody knows how to spell it.
Agreed.
So thank you for listening to Real Estate Breakthrough. So exciting to have you guys here, and we'll post another show in 2 weeks.